Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Wednesday everybody. Though yesterday wasn't a particularly happy day for the residents of Beijing and other parts of the north, who woke up to dusty yellow skies, hit by yet another sandstorm from neighboring Mongolia. According to the Beijing Municipal Ecological and Environmental Monitoring Center, by 8 a.m. Beijing morning, concentration levels of PM10 exceeding 1,000 micrograms per cubic meter, more than 20 times the one-day maximum average, were found in the air. These are extremely hazardous levels. Over 400 million people, mostly in the north, were affected. Let's hope conditions improve for these folks there in the coming days. First up, the Chinese economy. Indeed, most of this episode will be on economic updates, but specifically for the first update, we look at the AI sector. Does China have an AI bubble? This is a topic which we have returned to sporadically over the last 12 months or so. Of course, the thing about bubbles is that we typically cannot be sure they exist until after they pop. But we briefly return to this question again today because it appears that regulators, in Beijing at least, are concerned that there is indeed a bubble in AI stocks. On Monday of this week, state-run financial outlet, founded by the State Council, the Economic Daily, published an article titled "Bubble Prevention Needed While Promoting AI," warning of an AI bubble forming due to a ChatGPT frenzy. The piece expresses, quote, "While capital is chasing the ChatGPT concept, it needs to pay attention to avoid running into a bubble," end quote, pointing out that domestic stocks related to AI have surged over 50% in 2 months. Quote, "The mature development of ChatGPT requires the attention of capital and effective pricing in the market, rather than excessive hype. According to historical experience, the valuation of a company will eventually return to the fundamentals of performance. If the performance is far from the stock price due to speculation, it will eventually fall back to the original point. We can vividly remember this story before with blockchain and metaverse, from the overnight explosion to the great fall," end quote. A lot of players are pouring into the AI sector nonetheless in China. Alibaba's answer to ChatGPT was unveiled this week on Tuesday. With Chinese and English language capabilities, the model will first be deployed on DingTalk, Alibaba's digital cooperation workplace, and voice assistant TM Genie. The e-commerce giant said on Tuesday that the AI product can draft emails, solve math problems, write codes, and convert text to images. Chinese internet giant Baidu has also unveiled its own ChatGPT rival, called Ernie Bot. However, Chinese financial media outlet Caixin published a report this week warning that the Chinese AI sector faces serious structural challenges. Quote, "To train large-scale models like ChatGPT, at least 10,000 A100 chip clusters and at least 2 billion yuan, $291 million in hardware investment are needed. Chinese companies possess only 40,000 A100 chips, mostly in the hands of internet giants such as Alibaba and Baidu," end quote. The piece also argues that with a relatively low entry barrier and with the support of venture capital, many small and medium-sized companies have crowded into the AI-based application programming interface API market, intensifying the competition, adding that, quote, "Companies will soon enter a vicious cycle of price wars," end quote. Meanwhile, on the topic of AI and the AI sector generally, yesterday China's powerful internet regulator issued a proposed set of new rules for artificial intelligence. The Cyberspace Administration of China proposals said providers would have to submit their products for security reviews before their public release, and it would set up a database to register them. The regulator also said platforms must verify users' identities, allowing usage to be tracked. The proposals make it very clear what Beijing expects of AI. Quote, Content generated by generative artificial intelligence should embody core socialist values and must not contain any content that subverts state power, advocates the overthrow of the socialist system, incites splitting the country, undermines national unity, promotes terrorism and extremism, promotes ethnic hatred, ethnic discrimination, violence, obscene pornographic information, false information, or may disturb economic and social order. End quote. This week too, the Payment and Clearing Association of China, a national financial industry group, warned, quote, AI tools have manifested risks including cross-border data leaks, end quote. Next up, more on the Chinese economy, and we look at the good, the bad, and the ugly. Hey guys, if you enjoyed today's episode of China Update, don't forget to hit that like button. It's just me making these episodes every day. It's a lot of work, but your guys' support is a huge source of motivation. Subscribing and sharing is a huge help as well, and for those who can go the extra mile and help me keep the channel financially sustainable, Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. Okay, next up, the Chinese economy generally, and we have a lot of economic data and analysis published from the last 48 hours or so. Let's move through some of the key points. As always, official numbers we take with a grain of salt, but we must at the very least be aware of them. Let's start with the good and then move to the bad and the ugly. Goldman Sachs Asset Management, in a note yesterday, told investors it sees opportunities in China's property firm's high-yield dollar notes for those with high risk tolerance. Currently, bond prices for these notes average around 50 cents on the dollar. Goldman Sachs believes that the market has not priced in the more optimistic outlook yet. Quote, the high return opportunity, in our view, exists today in private developers, both in companies that have not defaulted, but also in some companies that have. Our view is that most of the defaults are done. There may be a few more defaults or distressed exchanges, but systematically, most of the pain is behind us. End quote. This is a rather optimistic and bullish view from Goldman Sachs. Regular viewers of China Update will agree that the property market, in the short term, is in a much better place than last year. Indeed, much of this has already been priced in, with real estate firms' high-yield dollar bonds returning about 53% in the fourth quarter of 2022 from very low bases. However, the current situation, I would argue, still remains unstable and uncertain. Okay, now moving to the mixed news. On yesterday, the People's Bank of China said that aggregate financing, a broad measure of credit, reached 5.4 trillion yuan, approximately $784 billion last month, beating expectations. Also beating expectations, financial institutions offered 3.8 trillion yuan worth of new loans. Quote, if the trend in credit growth extends into April and May, it would translate into significant support for the economy's recovery through investment financing. End quote. But, as usual, Peking University finance professor Michael Pettis explains how the implications of this are very much a mixed bag for the economy. Quote, a total increase in aggregate finance in Q1 is equal to roughly 44% of the period's GDP. It seems that Beijing is determined to ensure GDP growth this year of over 5%, but if we expected any meaningful consumption rebound, this kind of credit growth seems like overkill. End quote. Indeed, this is very much a theme we covered in the last two episodes, the idea that Beijing may have to rely more on debt than previously anticipated, as consumption may not be as strong as hoped. Pettis continues with his observation from today, quote, I always thought that Beijing would easily be able to hit the GDP growth target this year, with the debt-to-GDP ratio rising only 2 to 3 percentage points compared to 12 percentage points last year. But even if credit growth slows substantially over the rest of the year to a more normal 10% annual pace, it is hard to see how the debt-to-GDP ratio doesn't rise by at least 5 percentage points in 2023. And this was supposed to be an especially light year for debt. End quote. On Tuesday, the National Bureau of Statistics said that the Consumer Price Index rose 0.7% year-on-year, the slowest pace since September 2021, and weaker than the 1% gain in February. This was well below expectations. The Producer Price Index, PPI, fell for the 6th straight month. For some of us in the West wrestling with inflation, this may sound like a good thing. But China's economic challenges are quite different, and as such, direct comparison is not very useful here. An imperfect but conceptually useful metaphor would be that of an obese person versus an anorexic person. Both persons have unhealthy eating habits, but the nature of their respective issues is quite different. China has very weak consumption. Low inflation is a symptom of this. In response to this low inflation, yesterday in state-run Shanghai Securities News, former central bank advisor Li Yang called on the People's Bank of China to provide more support to fiscal policy. We remember Li recently spoke at the China Development Forum, where he called for urgent action to deal with local government debt through institutional reform, which includes the selling of local state assets. And finally, for today's video, and the economy specifically, we move now to the ugly. A few days ago, we discussed the painful 2022 Hong Kong-listed Chinese brokerages had. Now, according to unaudited data released by the Securities Association of China, we can see that mainland-listed securities companies didn't fare much better, with one commentator calling the performance disastrous. Chinese financial media outlet Caixin writes that last year, the total net profit of 140 securities companies fell 26% to 142 billion yuan, $21 billion, quote, owing largely to lower returns on their investments, end quote. Their combined revenue dropped 21% to 395 billion yuan. Caixin calculates that the audited annual reports of 23 securities brokerages listed on the mainland were equally disappointing, with total revenue and net profit being down 22% and 29% respectively. Quote, the financial assets held by the company's proprietary business were impacted by market fluctuations, so the returns on investments and profit from the change in the fair value both dropped year on year, leading to a considerable change in the company's net profit, which declined 98%. End quote. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a wonderful day wherever you are, and I will see you all tomorrow.